All right, so is Houston still a good market to invest in 2026? We're going to look at last year's data, what was going on as far as like the last quarter, and we're going to look at recent trends or recent news that is coming out as far as Trump banning institutional investors and what does that mean, and the recent news of him requesting the Fed to buy, I think it was like 200 billion worth of mortgage-backed securities, not the Fed, Fannie and Freddie Mae. So let's get into the data. First things first, let's look at. So this is data that came out from December, looking at November data points, right? So here's December piece, November. And the first thing that I wanted to point out was this is coming from the Houston Association of Realtors that single family homes dropped year over year for the first time since April. Basically meaning that in April of 2025, it was the first time you saw a dip, and then we're going to see that again in November. Now, one thing to note is April is kind of surprising because it is, springtime. Springtime is usually known for, higher transaction rates. But again, we're looking at year over year. So what is 2025 look at 2024, right? So looking at that, when November is usually a time of, slower transactions or slower sales overall, we're not looking at that. What we're looking at is year over year. So sales were down from 2025 looking at November and 2024 looking at November. So if November was low in 2024, that means November is even lower 2025. The total is 6,347 in November of 2025. And then you see the decrease in November of 2024, 6,499. It isn't a huge amount, but it's still significant. Right? Now, the next piece of data is we're going to look at pending sales. Now, what does pending sales kind of imply, or what does that mean? We're looking at 7.2% year over year. What Har is saying is signaling continued demand and ongoing market activity, which I agree, yes. But it also can imply that there are more buyers looking at purchasing properties, whether investors or first-time home buyers. But overall, there's a higher demand in buyers, implying, right? We're going to look at other data. Let's just go look at that data. So that data of kind of proving that there is a higher demand in buyers is we're looking at mortgage applications. So there are more mortgage applications in this time than there was last year, right? So going back to the data, the other thing that it kind of implies is that sellers are accepting lower offers. It kind of implies that because, again, that basically pending sales rising, meaning there is more people going into contracts or accepting offers. Now, whether they actually close on that, we don't know. It's just pending sales, right? So what does that mean? It means that sellers are being more open to accepting whether it's lowball offers or just offers in general. This next piece is home prices continued to slightly moderate in November. So the median price declined 1.5%, dropping down to 325,000. Now again, we're looking at the overall market in Houston from November year over year to November the year before, right? While the average price edged up 0.8% to 422,000, driven mostly by the luxury market. So in this case, the price decline of 1.5% is significant for the median home price, right? It is significant because it is showing that, again, maybe sellers are accepting lower offers. But overall, we're looking at lower homes overall. Later on, I'm going to show you a data point where it shows specific areas because we know Houston is big. So let's say the west side versus the east side or the south side. Each area has different median prices, right? Because we're excluding maybe luxury areas. But this kind of does go to show that there is kind of still a K-shaped recovery, which implies that the lower income market is lowering again, hence the decline of 1.5%, and the luxury market, or the higher income tier, is, I guess in this case, growing 0.8%. All right, but let's continue looking at the data point of average list to sell price. Right now, I think this is a little bit more. This is the data that I was talking about that kind of proves that maybe sellers are accepting less. Right, so reflecting the shift market conditions, the average list to price ratio declined 9.2%. Sorry, 92% in November, down from October. So what does that mean? Start that over. Reflecting shifting market conditions, the average list to sell price ratio declined 92.2% in November, down from October, and the lowest level since HAR began tracking the metric in 2001. Now, this is very significant. Why? Because, again, this is the data point that I was referring to, that probably sellers are accepting lower offers. What does that mean? Like, how do you know? Because the average list to price ratio declined 92.2%, meaning if a home was priced at, let's say, 400,000, right? That means that the seller accepted 92.2% of that, which is 368,000, right? So let's say I have a home that's priced at 400,000 and I list it out onto the market. 30 days, 60 days have passed by and it hasn't sold. So I'm getting a little bit desperate, and I've gotten offers that are a little bit lowball, but I've been saying no and no because I want my price of 400,000. Time has passed and I'm not getting that offer. So what do? I'm going to accept those lower offers, and that is what the list to price ratio is. In this case is 92.2%, or in this case, I'm going to be selling my house for $368,800. Again, going back to the theory of sellers accepting lower offers, that's where I get my theory from. All right, now let's look at the rental. So this was HAR. Wait, before I move on to the rental, I want to go down to, here it is. So I did talk a little bit about the mortgages slightly, but affordability improved year over year for buyers, with the average mortgage rate dipping 6.8% in 2024 to 6.24%. Now, I'm going to go a little bit deeper into this as far as like what are the rates right now. But again, year over year, November from 2025 to November 2024, there was an increase. There is more affordability because interest rates went lower, right? Now, the last one that I did want to slightly touch on is homes spent on average 60 days on market in November, up from 53 days on market, meaning homes are staying longer on the market. Whether that's because, again, sellers are struggling to accept those lower offers, which is, again, another one of my theories. Or there isn't, even though there is a bigger buyer pool, there isn't enough. So we need more buyers. So before we go into the news of what's happening now, I want to look at the renters landscape. So the current median rent is $1,800 per month, right? Which is a rent growth year over year change in 10% higher. Now, so Realtor.com is saying that there is a sustained demand across neighborhoods. I tend to not necessarily agree, and I'll show why. Is because, again, we're looking at the metrics of Houston overall, right? Again, we're looking at, and now this one is October, but year over year of negative 3.12%, right? over the 3 years is 6.25%. But again, this is Houston. If we want to look at like specific areas, let's see. So the west side. I'm kind of closer to the west side. So we're looking at the west side of 285,000 as the median home price, right? Versus overall Houston is 320, right? There are some areas where you exclude luxury markets, which is why you get different median price ranges, right? Some areas are higher than others, right? For example, if you look at the inner loop, is going to be higher. The same thing with the rental market. I'm going to give you a quick tip or a quick hack when it comes to rent. If you're looking at rents right now, Houston is kind of like the hub for development, and there has been a lot of development in the past years. I think 2025 was the year that had the most amount of multifamily complexes being built up. And it's a good thing for a lot of renters because there is a lot of competition. Here's the hack that I'm gonna give you. If you're looking at an apartment, a lot of them are gonna have concessions, especially the ones that have been built recently. And that's a good thing for a lot of renters because you're gonna get really good amenities, up-to-date amenities, and you're gonna get those concessions. Now, here's another hack. If you get, let's say, a month or 2 months rent free, right? A lot of these apartments are gonna try and get you with those 2 months free rent, right? Instead of just taking those 2 months free, you can use, in this case, credits of 2 months free rent, and then put that into the monthly rent, and you can decrease your monthly payment when it comes to those apartments, if that makes sense, right? So that's just a quick hack that you are able to use. Again, so I do tend to agree, but again, it depends on the area and the location. If you don't care about the location, then you can kind of use that to your advantage. If you have a realtor that will help you with locating, you can find a really up-to-date 2000 brand spanking new 2025 apartment and have the same rental rate as, let's say, an older apartment in the same area. Why? Because they want to have that property, that multifamily, that apartment rented out. All right. Now let's go into the recent news. Now, here's the thing that I was going to talk about. Mortgage rates, right? Affordability has come down, as the Houston Association of Realtors has indicated. Mortgage rates dipping from 6.8% to 6.24%, and as we're looking at today's rates, 6.01 on a 30-year fixed rate. Right now, what is the recent news that we have heard from the White House or from the Trump administration is that he's looking to, well, let's go into this mortgage bonds really quick because that relates to mortgage rates, right? So Trump's latest proclamation, what is his latest proclamation means to homeowners? So in his move to make owning a home more affordable, he has directed the federal government to purchase $200 billion in mortgage bonds, right? Using the cash reserves from Freddie Mae and Fannie Mac. I always get them confused. Fannie Mae and Freddie Mac. So again, that means what that means. Now, is there going to be a inflation implication? Maybe, but this is going to temporarily bring those rates down because it is going to directly affect the 10-year yield curve and bring those mortgage rates down. Again, right now we're at 6.01% on the 30-year fix. Will it get down to 5.7, 5.8, possibly a 5.5? I don't know. That's what the 15-year rate is right now, 5.5. If we can get that 30-year fixed rate for 5.5, that would be significant. And again, if we pair all the information that we got from the affordability coming down to, prices coming down, this will be a good year for buyers, right? I get that question asked a lot as a real estate agent: is Jesse, is right now a good time to buy? And I usually tend to go to yes, because overall, like Trump has said that it has been we didn't go to that quote yet, right? That owning a home is, wait, where he said that buying and owning a home has been considered the pinnacle of the American dream. And I do tend to agree with that. Again, as you buy more assets, especially a home, that would increase your net worth and will help you overall in your financial journey of becoming financially independent. I always preach that own assets, because again, as you saw the K-shaped recovery, people who own assets, their assets will increase as time passes, and people who don't own assets, because the dollar decreases in value, inflation, then a lot of people lose their net worth, right? So overall, wait, let's quickly finish this last point of institutional buyers. So to finish that quote up, record high inflation caused by Joe Biden, the Democrats, whatever. It is for that reason and much more that I am immediately taking steps to ban large institutional investors from buying more single-family homes, and I will be calling on Congress to codify it. People live in homes, not corporations. I do agree with that last part. Now, whether it is going to take into effect, I don't know yet. But is it going to make a big impact in the housing market? I do think, but it's not going to be as big of an impact that most people think, right? If we look at the information that we get from who owns most of the single family homes, it's mostly going to be mom and pop, right? So 89.6% of properties are owned by mom and pop. And if we look at what those, we don't know what institutional investors is it more than 500 homes? Is it more than 1,000 homes? Is it more than 100,000 homes? But either way, if we look at the percentage of corporations or institutions that own properties, it is very low. So institutions that own more than 1,000 plus properties is 1.6%, right? And if we look at 100 to 1,000, 1.1%. So we've always known that institutional buyers have been slightly lower than I think it was between 1 to 3%. So overall, it isn't a huge impact if we restrict institutional buyers from buying properties, right? Now, I want to bring all of this data into just one kind of like summary, right? So home prices are down, inventory is up. We're looking at sellers accepting lower offers, possibly more buyers in the market. We still need even more buyers, which looking at the new data or the news, there's possibly going to be more. Again, why? Because of there's going to be temporarily more new buyers because of the fact that if this actually happens, where Fannie and Freddie may end up buying $200 billion worth of mortgage-backed securities, that is going to bring the interest rates down, possibly to 5.5 to 5.67%. And that is gonna bring more of a buyer pool into the market, bringing prices maybe up. Now, here's the thing: is more demand gonna bring properties higher? Because that's what we've seen. I don't know. Even if we do bring more buyers, I don't think it's necessarily gonna bring prices up. Again, why? Because even in the past year in 2025, where prices have come down, where mortgage applications have been higher, we still haven't seen a pause or an increase in prices. So will more buyers coming into the market, flooding the market, cause prices to come up? I personally don't think so. So overall, the golden question is: right now a good time to buy? I think right now is prime time to buy, especially if that if those $200 billion actually go to buying mortgage-backed securities and brings those interest rates lower, then I think yes, right now is a prime time to buy. It is still a good time for investors to buy here in Houston, as we've seen rentals, stay around 800. Sorry, stay in between 16 to 1800. Still a good, you can still own a property and cover your rent. So if you have any questions when it comes to the Houston market, feel free to reach out. I am an investor agent, meaning as an agent, we work with investors. So I have partnerships with a lot of people here in Houston when it comes to wholesalers, sub two members, investors. We have those relationships.